Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of business filings. And sometimes it feels like companies are trying to hide things in plain sight, but we're here to decode it all, so buckle up because Nuburu Incorporated recent SEC filing is a wild ride with a lot of numbers that might make your head spin. And some very creative accounting decisions. So Nuburu, they make these high-powered blue laser thingies, and they've been having a bit of a tough time lately. They've been through a lot of financing juggling and some pretty significant business shifts. So let's dive into what their latest filing really tells us about where they are and where they're going. First off, we're looking at a Form S-1, a registration statement for selling more shares, which is always an interesting sign, especially when they're talking about up to 130 million shares of common stock. This filing is also heavily focused on a standby equity purchase agreement, meaning they can sell more stock to an investor which can dilute existing shareholders. So that is a big deal. The main story here is their deal with Yathaki and Ltd. The selling stockholder is looking to sell a lot of shares, and the company itself might sell shares to this investor, to potentially bringing in more money, but also potentially hurting the stock price if too many shares flood the market. This is a huge red flag for investors if the company sells shares. Then the selling stockholder sells shares, people buying at different times will pay different prices, and that can mean a lot of dilution for existing shareholders. Keep that in mind. Alright, let's talk about their business strategy. They've announced a bunch of acquisitions and joint ventures with companies like TechniSime, Orbit, and Lyoken, but the filing is very clear there is no guarantee these deals will actually go through. That is a big risk right there. They've already put a lot of money into some of these potential acquisitions, and if they don't close, they might not get that money back. Now, for the gritty details, Nuburu is an early stage company and they have a history of losses. They have not been profitable, and there is no guarantee they will ever be profitable. This is a critical risk factor for anyone looking to invest. They anticipate continued losses for the foreseeable future and need a lot more capital to keep things going. If they can't raise that money, it seriously puts their operations at risk. This is a major concern. They had to restate their financial statements, meaning their previous reports were incorrect and they found material weaknesses in their internal controls. If a company can't even get its accounting right, it makes you wonder about the rest of its operations and its ability to manage the business effectively. Here is something important for shareholders if you own common stock. Remember that it is considered less valuable than the preferred stock. The company has issued this means in case of trouble. Like liquidation, preferred stockholders get paid first, common stockholders get paid last if there is anything left. Let's look at the actual numbers, okay? This balance sheet for the 31st of December 2024 shows total assets of about $7 million. But look at the liability sections. You see accounts payable and accrued expenses that sum up to over $20 million. This is a common sign for companies struggling with cash flow. They owe more than they have in readily available assets. Now, for the income statement for the year ended the 31st of December 2024, they reported revenue of just over $152,000. But their cost of revenue and operating expenses were over $13 million. That is a huge loss of over $13 million. Just from operations, before even considering interest and other costs like extinguishment of debt, which added over $20 million in losses. This is a massive discrepancy between selling things and the cost of running the business. Let's break down these numbers from the 2024 income statement. Revenue dropped significantly to just over $152,000 compared to over $2 million in 2023. Cost of revenue also dropped, but not enough to offset the revenue loss, leading to a bigger gross margin loss. They're cutting costs, but it seems like the business is shrinking even faster. And the loss per common share is eye-watering, a loss of $5.91 per S-share in 2024 compared to just 63 cents in 2023. This is a dramatic increase in losses. Per S-share, meaning existing shareholders are seeing their ownership value decrease significantly. Moving to the more recent numbers for the 30th of September 2025, you see cash has jumped up to almost $6 million, which is good. But look at the liabilities. You've got total liabilities of over $67 million. This means they still owe a lot more than they have accessible cash. In the 9 months ending the 30th of September 2025, the net loss is over $51 million. That is almost double the loss from the same period in 2024. This jump is driven by a lot of non-cash charges and losses on debt extinguishment and issuance, but the operational picture is not pretty either. This filing mentions a massive loss on the extinguishment of notes payable. During the 9 months ended the 30th of September 2025, totaling over $10 million. This often happens when companies restructure debt, and the cost of doing so is huge. It highlights how much they are struggling financially. Back to the strategy side, these acquisition plans are still uncertain, and they've already spent a good chunk of money on them with little guarantee of return this whole acquisition. Spree feels like a gamble to stay afloat, maybe hoping one of these might turn things around, but it is high risk. They admit they rely heavily on a few key people, and if they lose them, it could seriously hurt the company, plus their management team has limited experience running a public company that is already a recipe for trouble. So what is the story here? Nuburu is in a precarious position. They're trying to grow through acquisitions and use equity financing to stay alive, but they have a history of massive losses week. Null controls and a stock price that has been struggling. They've had to restate financials and are currently not in compliance with nice American listing standards. The company's direction is all over the place, with laser technology development shifting towards licensing and then jumping into defense tech software and drone ventures. It feels like they're trying everything to find a successful path forward. My take on Nuburu is that it is a highly speculative investment right now. The company is burning through cash at an alarming rate, and while they might manage to secure more funding, the risks are immense. The repeated need for financing and the significant dilution to existing shareholders created by these equity deals are major concerns. The acquisitions are gamble, and the financial health of the company is fragile. The sheer number of financial instruments and complex transactions suggests a company in distress trying to manage a very difficult financial situation. The valuation of many of these instruments relies on complex models with unobservable inputs, meaning the company's own estimates are a big factor in their reported numbers, which can be a red flag. In conclusion, Nuburu is in a fight for survival. It is a high-risk, high-reward situation, but right now the risks feel significantly higher than the potential rewards. Investing here would be a very speculative bet on their ability to execute these ambitious and somewhat scattered growth plans and overcome significant financial and operational hurdles. What do you all think about Nuburu's situation? Are they a diamond in the rough, or a company you'd steer clear of? Let me know your thoughts in the comments below. If you found this deep dive into Nuburu's filings helpful, please give this video a like and subscribe for more corporate decoder insights. And don't forget to join our Discord community linked in the description below to continue the conversation and get access to exclusive content. Thanks for watching, and we'll see you on the next Decode.